You know that feeling. It starts in your stomach. It's that tightness right below your ribs when you see the email notification pop up on your phone from the bank. You've been waiting 3 weeks. You sent in the tax returns, you sent in the P&L, you explained your vision to the loan officer who smiled and nodded and told you things looked promising. You've already mentally spent that capital. You see the new equipment, the marketing campaign, the second location. You see the legacy you're trying to build for your kids so they don't have to start from zero like you did. You click the email, and it's not a congratulations. It's a notice of adverse action. Denied. They don't tell you the real reason why in the email, just some generic code about insufficient cash flow or debt-to-income ratio. And you sit there, staring at your phone, wondering how you're grossing 6 figures, but the bank treats you like you're broke. You start wondering if it's the business, if it's the economy, or if it's just you. If it's your zip code, if it's your last name. That anxiety isn't just about money, it's about validation. And getting a no when you know you have a winning product is one of the most demoralizing feelings in the world. But I need you to stay with me, because that no usually isn't a dead end. It's a math problem, and math is something we can fix. What's good, everyone? It's DeAndre Robson, and welcome to No Noise Finance, where we cut the fluff, ignore the hype, and talk about the raw numbers that actually dictate your life. If you are tired of generic advice like just save your latte money and you want to know exactly how to structure a business that banks fight to fund, you are in the right place. Today, we are going to war against rejection letters. We are going to dissect why nearly half of small business loan applications get thrown in the trash, and I'm going to teach you the specific cash flow narrative you need to use to force that underwriter to press the approve button. If you want to stop begging for capital and start commanding it, make sure you subscribe because we are dropping the blueprint today. Look, I was just reading the latest Small Business Lending Index report that came out recently, and the numbers are ugly. We are looking at a landscape where big bank approval rates for small business loans are hovering around 13%. Small banks are doing a bit better, sitting around 18 to 20%, but when you look at the aggregate data, specifically for SBA loans and unsecured lines of credit, we are seeing denial rates hitting that 47% mark for many applicants. And when we look at the breakdown by demographic, the picture gets even clearer and honestly frustrating. According to the Federal Reserve's most recent small business credit survey, fully funded approval rates for white-owned firms sit at roughly 54%, while for black-owned firms, that number drops to 26%. Hispanic-owned firms are right in the middle at around 32%. Now, you can look at those stats and get mad, and you should be mad because the systemic bias is real, but getting mad doesn't print checks. The news is screaming about a credit crunch and high interest rates, with the prime rate sitting high, meaning your SBA loan is likely costing you 11 or 12% interest. The media tells you the economy is scary, so you should retreat. I'm telling you the economy is rigorous, so you need to get technical. The banks are tightening their belts, which means your application can't just be good, it has to be bulletproof. Let's get into the raw truth, no sugarcoating. I need to have a difficult conversation with you, specifically my people in the building. There is a massive disconnect between how we are taught to handle taxes and how we need to handle banking. For years, you've been told by your uncle, your cousin, or maybe even a subpar accountant that the goal of business is to pay 0 taxes. You make $100,000, you write off the car, the dinners, the home office that's actually your living room, the travel, the clothes. You deduct everything until your taxable income shows $10,000. You feel like a genius in April because you don't owe the IRS a dime. But then you walk into a bank in June asking for a $200,000 loan, and the bank laughs you out of the room. Why? Because you just told the federal government under penalty of perjury that you only make $10,000 a year. You cannot have it both ways. You cannot look broke to the IRS and rich to the bank. This is the tax write-off trap. For Black and brown business owners, this trap is lethal. We are often starting with less capital, so we're desperate to hold on to every dollar of cash flow, leading us to over-deduct. But the bank doesn't lend on your potential or your hustle. They lend on your tax returns. If your tax return says you are poor, the bank believes you. The reason you aren't getting funding isn't just the color of your skin, though that forces you to be twice as good. It's that your paperwork is telling a story of a failing business. The underwriter looks at that return and says, this person can't even pay their own rent. How can they pay back my $50,000? We have to stop sabotaging our own borrowing power to save a few $1,000s in taxes. Sometimes you have to pay the tax man to show the bank you have the muscle to carry that loan. Let me break this down with some math and a story, because this is where the cash flow narrative changes everything. Let's talk about a fictional business owner named Marcus. Marcus runs a trucking logistics company. He's grinding. His gross revenue, the top line money coming in, is $300,000 a year. He feels successful, but Marcus listens to bad advice and aggressively writes off everything. Fuel, depreciation on the trucks, meals, per diems, his cell phone, his internet. By the time he gets to the bottom line of his Schedule C or his 1120S tax form, his net income is listed as $15,000. Marcus goes to the bank for an SBA 7A loan to buy another truck. The loan payment would be roughly $1,500 a month. That's $18,000 a year. The bank uses a formula called the DSCR, Debt Service Coverage Ratio. This is the holy grail of lending. The formula is net operating income divided by total debt service. The bank generally wants a ratio of 1.25 or higher. This means for every dollar of debt payment, you have $1.25 in profit to cover it. Let's run Marcus's numbers based on his tax return. His net income is $15,000. His proposed debt is $18,000. $15,000 divided by $18,000 equals 0.83. That is less than 1.0. That means he's losing money. The bank sees this and it's an automatic rejection. The computer denies him before a human even looks at it. Marcus thinks he was denied because he's black or because the system is rigged, but on paper, he's insolvent. Now, let's fix Marcus's cash flow narrative. This is what the top 1% of businesses do. Marcus gets a new accountant who understands add-backs. See, not all expenses are real cash leaving the bank account. Depreciation is a tax concept, not cash leaving your pocket. Interest on loans is something that changes with a new loan structure. Let's say Marcus actually had $40,000 in depreciation on his trucks and paid $10,000 in interest on old high-interest credit cards he plans to pay off. The bank can add back that depreciation and interest to his net income to find his true cash flow, often called EBITDA, earnings before interest, taxes, depreciation, and amortization. So now the math looks like this. Start with the $15,000 net income. Add back $40,000 depreciation. Add back $10,000 interest. Now his adjusted cash flow is $65,000. Now let's run that DSCR calculation again. $65,000 income divided by the $18,000 debt payment. $65,000 divided by $18,000 equals 3.61. Do you see that? A 3.61 DSCR is a superstar number. It's well above the 1.25 requirement. Marcus went from a high-risk, automatic denial to a preferred borrower just by understanding how to present the numbers. The business didn't change. The revenue didn't change. The narrative changed. He stopped hiding his income and started structuring his returns to show strength. This is how you bridge the wealth gap. You don't just work harder, you document better. So how do you actually execute this? I'm going to give you 3 specific steps to fix your cash flow narrative right now. Step 1 is the pre-flight check. Before you ever apply for a loan, you need to calculate your own DSCR. Don't let the bank do it for you first. Pull your last 2 tax returns. Find your net profit. Add back depreciation, amortization, and interest. Take that total number and divide it by your current annual debt payments plus the annual payments of the loan you want. If that number is below 1.25, do not apply. You will just rack up a hard inquiry on your credit report for nothing.
If you are below 1.25, you need to wait until you file your next tax return and deliberately show more profit. That might mean taking fewer deductions this year. It hurts to pay the taxes, but think of the tax bill as the down payment on your access to millions in capital later. Step 2 is the debt schedule preparation. When you apply, the bank will ask for a schedule of liabilities. This is a list of all your current business debts. Be strategic here. If you have a high-interest MCA or credit card balance that is killing your cash flow, explicitly state in your application narrative, proceeds of this SBA loan will be used to refinance Debt A and Debt B. This is crucial because if the bank sees you are using the new cheap money to pay off the old expensive money, they will exclude the old monthly payments from your DSCR calculation. This instantly boosts your ratio. You have to tell them the plan. Don't assume they will figure it out. Step 3 is choosing the right battlefield. Stop walking into Chase, Wells Fargo, or Bank of America if you are a small business with under $5 million in revenue, especially if you are a minority business owner with a complex story. The big banks rely almost entirely on algorithms. If you don't fit the box, you're out. You need to find a CDFI, a community development financial institution, or a smaller regional bank. CDFIs are federally certified banks specifically designed to lend to underserved communities and minority entrepreneurs. They are allowed to look at your story, not just your credit score. They can look at your global cash flow and say, okay, the tax return is weak, but look at these bank statements showing consistent deposits. They have human underwriters. Go to the SBA website and use the Lender Match tool, but specifically filter for CDFIs in your area. This is where you find the partners who actually want to lend to you. We have to stop looking at finance as something that happens to us. Finance is a language, and for a long time, we weren't taught the grammar. But now you know. You know that a denial letter isn't a judgment on your soul. It's a calculation of your DSCR. You know that hiding from the IRS means hiding from the bank. You know that you have the power to curate your financial identity. I want you to imagine 2 years from now. You didn't just get the loan, you deployed it. You bought the real estate, you scaled the inventory, you hired the staff. You are sitting at the closing table for your next acquisition, and the banker isn't looking at you with skepticism, they're looking at you with respect because your paperwork is immaculate. That is what we are building, not just money, but authority. So here is what I want you to do next. I want you to go pull your 2024 or 2025 tax returns, or your year-to-date profit and loss statement. I want you to do the math I just showed you. Calculate your DSCR. If it's under 1.25, sit down with your CPA immediately and say, we need to structure for lending, not just for tax avoidance. This is DeAndre Robeson, No Noise Finance. We don't just dream about wealth, we engineer it. Fix the narrative, get the money, own your future. I'll see you in the next one.